Avoiding common investment mistakes is crucial for building and preserving wealth over the long term. Here are some key steps to help you steer clear of these pitfalls. Welcome back to Caffeinated Money, your go-to source for financial education and stock market insights. I'm your host, Mike, and I'm here to help you brew up some financial success. In today's video, we're going to dive into how to avoid common investment mistakes. Whether you're a seasoned investor or just starting out, we've got something for everyone. So, grab your favorite cup of joe and let's get started. But before we do, if you're new here, don't forget to hit that subscribe button and turn on notifications so you never miss out on our latest tips and tricks to secure your future. Let's get into it. 1. Set clear investment goals. Determine your specific financial objectives, such as retirement, buying a home, or funding your child's education. Knowing your goals will help you tailor your investment strategy accordingly. 2. Diversify your portfolio. Diversification involves spreading your investments across different asset classes, stocks, bonds, real estate, etc., to reduce risk. The idea is that when one asset class performs poorly, others may perform better, mitigating losses. 3. Understand risk tolerance. Risk tolerance is your ability and willingness to endure the ups and downs of the market. It's important to align your investments with your risk tolerance. A financial advisor can help assess your risk tolerance and suggest suitable investments. 4. Research and educate yourself. Take the time to learn about investment options and financial markets. Understand the basics of stocks, bonds, mutual funds, and other investment instruments. Knowledge is your best defense against making uninformed decisions. 5. Avoid timing the market. Trying to time the market involves predicting when to buy and sell based on market fluctuations. Research shows that even professional investors struggle with market timing. It's often more effective to stay invested for the long term. 6. Have a clear investment strategy. Create a well-defined strategy that outlines your asset allocation, investment horizon, and risk tolerance. For example, you might decide to invest 70% in stocks and 30% in bonds for a balanced portfolio. 7. Avoid overtreating. Frequent buying and selling of investments can lead to high transaction costs and capital gains taxes. Moreover, it's challenging to consistently make profitable trades. A buy-and-hold approach is often more cost-effective and less stressful. 8. Stay informed. Keep up with financial news and trends to make informed decisions. Understanding how economic events can impact your investments helps you stay ahead of potential risks. 9. Have realistic expectations. Be skeptical of investment opportunities that promise extraordinary returns with minimal risk. High returns usually come with higher risk. Be prepared for market fluctuations and losses along the way. 10. Monitor and rebalance your portfolio. Regularly review your portfolio to ensure it still aligns with your goals and risk tolerance. Rebalancing involves adjusting your asset allocation if it drifts significantly from your original plan. 11. Avoid chasing hot tips. Tips from friends or social media can be enticing, but they often lack the necessary research and analysis. Rely on your own due diligence and consult trusted sources for information. 12. Have an emergency fund. Maintain an emergency fund with several months' worth of living expenses in a liquid, easily accessible account. This provides a financial safety net, reducing the need to sell investments during emergencies. 13. Consider professional advice. If you're uncertain about your investment decisions or have complex financial needs, consider seeking advice from a certified financial advisor or planner. They can provide personalized guidance. 14. Learn from your mistakes. Recognize that everyone makes investment mistakes at some point. When you do, analyze what went wrong and adjust your strategy accordingly. Learning from your mistakes can make you a more skilled investor. 15. Avoid emotional decision-making. Emotions like fear and greed can lead to impulsive investment decisions. Implement strategies to keep emotions in check, such as setting predefined exit points for your investments and sticking to your plan. Remember that investing is a journey, and it's okay to start small and gradually increase your investments as you become more confident and knowledgeable. Staying disciplined, patient, and well-informed are keys to long-term investment success. Hey! That's it for today's deep dive into the world of finance. I hope you found our discussion on how to avoid common investment mistakes insightful and valuable. Remember, the key to financial success is knowledge, and that's what we're all about here at Caffeinated Money. If you enjoyed this video and found it helpful, don't forget to hit that like button and share it with your friends who might also be interested in growing their wealth. Your support helps us create more content like this. And if you haven't already, click that subscribe button and the bell icon so you won't miss out on our future videos. We've got a lot more financial insights and stock market tips coming your way. Before we wrap up, I'd love to hear from you. What was your biggest takeaway from today's video? Do you have any questions or topics you'd like us to cover in future videos? Let us know in the comments below. Remember, the journey to financial success is a marathon, not a sprint. So, keep learning, stay invested, and let's make that money work for us. Until next time, this is Mike, signing off from Caffeinated Money. Stay savvy.